Hello guys, welcome to the Trading Parrot. There are plenty of people at the moment talking about the typical performance of Bitcoin post-halving years during the month of January. It's no news that January has taken more than one by surprise, seeing some drawdown at the moment of almost 16%. And by looking at the past performance, people are starting to speculate what could be the area that we should be bouncing. In today's video, I'm gonna put a special focus on past performance. We're gonna look at 2013, 2017, 2021. Those 3 years are in a similar time based on halving events, but we are also going to make a stop in 2024 in January because some people are starting to get tempted to compare it as well with 2025. Of course, we're going to look at liquidity levels and all the usuals. That's going to come more a little bit towards the end of the video, so make sure you watch it all so you don't miss the due diligence analysis as well. Guys, if you like this type of content, make sure that you're subscribed to the channel, hit the notification bell to get notified every time I put out one of these videos. Thanks so much. Yesterday, guys, we got 5,000 views in the video. There's been some videos before with over 800 to 1,000 likes. If you like the content, make sure that you don't forget to hit that like. That really helps the channel, driving new people to jump on board as well. Just for the context, today there are not necessarily big events when it comes to US, but on Friday there's big expectations in terms of impacting the markets, and I'm talking about the general markets from the unemployment rate on Friday. And that's of course because unemployment rate increasing too fast could be one of the aspects that could change the mind of the Fed, making a U-turn and potentially reactivating the money printing, weakening the dollar, and helping risk-on assets to have a better prospect for the rest of the year. I'm gonna jump straight into the past performance, have a look at the timestamps. If this is not what you want to watch, you're gonna skip into the usual daily analysis. You can do so from the description. And I'm sorry guys, my voice is gonna be a little bit tough today. I'm quite sick, but no matter what, there's always the video. So I'm gonna use this chart just to give you an overview, the big picture on the weekly time frame using a logarithmic chart together with the bull market support band. The bull market support band consists of an SMA plus an EMA. The SMA is with a length of 20 on the weekly and the EMA with 21. So let's start from the beginning. In 2012, December and January 2013, that is the first time that we can do an analysis post-halving event. The red line in here is the actual halving event. And you can see that from December into January, the price was just sideways, preparing for the first leg of the rally of 2013. We could argue that neither from December or January there is any significant drawdown. We can barely measure volatility with a single digit around that area. If we wanted, we could use August as the top, and still seeing the drawdown in January is just 13%. So we can kind of ignore this area of the price. Is very flat and is respecting the bull market support band prior to the halving and after the halving, at least until July 2013. Let's go into the next halving, that is 2016, and now we can start seeing a little bit of the patterns that everybody's talking about. We see a top in January 2017. Notice that the top is in January. Our top was in December, a little bit earlier, almost a month before. And from that top of $1,165, we find a bottom almost 36% below it, and that is within the month of January. So we start January from a top, we have the 36% within the same month, and notice that by the end of January we still cannot overcome the highs of January. We only do that in February. So that is a very important pattern when it comes to expectations for January coming from 2017. Now let's continue going forward because patterns are not always the same, but they tend to rhyme in different aspects, and we're gonna see which of those aspects could be still relevant in 2025. In 2020 there was the COVID crash. That was prior to the halving event. Halving event occurs in May, and we start rallying from September, testing the bull market support band once, and we don't touch it ever again until May of 2021. Equivalent to this cycle, that will be like May this year, but we already know that in this cycle the bull market support band has kind of lost that idea of being such a strong support during bull markets, because indeed we tested it twice, but on the third time we spent more than a month below it and in this area here as well. So we need to take that in consideration for this particular cycle. Now looking at December and January in this particular cycle, you can see that we find a top on the 4th of January that rhymes with the 2nd of January in 2017, and the drawdown in this case is only 30 to 31%, and it doesn't touch the bull market support band, contrarian to what we did in 2017. From the top being in January, at the end of January we are still at the lows. So So we come from being above 40K, so something like 42K, and by the end of January, we are still in the last week around 33 or 30 something K. In the first week of February is where we managed to at least to take the highs, actually the highest closing price of January. So again, when we have that drawdown, we tend to recover from it in February. It takes a while. So those are two cycles that we are comparing. We are living kind of outside 2013 because there is no drawdown, significant at least. We can also compare with the previous year. That is something that people are doing, but later in the video, I'm gonna tell you why I'm not doing such a comparison. But let's start and naively, let's do it and let's discover together why that might not be the best idea. It's very tempting though, I admit, but there are some key factors that we need to cover. So 8th of January, there is a high. So that rhymes again with the previous patterns, at least 2017 and 2020. Then we have a low around the end of January, and on the first week of February, we take the highest closing price of January. And in mid-February, we already took the highs of January. We don't touch the bull market support band, but we come very close. So the lowest price is 38.6, and the bull market support band at that point is at 37.4. So we are around 1K close to the bull market support band. So let's look at where we are now. We put a high that was mid-December. So that is the first pattern. This thing is happening earlier, around 2 weeks relative to any of the other patterns, including the one last year. So far, our low is at 91K, and that represents roughly a 16%. So if we were to compare just drawdown in terms of percentages, we have 16% in here, and we have over 30% in the two cycles that we have at hand. 2013 has barely less than 10% drawdown. It's not even visible in the chart by naked eye. So if it was a linear regression from 36, 31, just doing a finger in the air, I will say drawdown should be somewhere between 20 and maybe 25% possibly. A 20% will be hitting around 86K, and a 25% will be hitting 81K. Depending on the timing of that, which we already say we are 2 weeks ahead, that's also very relevant. Typically, the bottom happens within 2 or 3 weeks post that top. So the top in here is early January, the top in here is early January, and in 1 to 3 weeks, we have already bottomed. From the top, which occurs on 16th of December, we are already 3 weeks ahead. 1, 2, and 3. And we are still holding, but we are forming a candle at the moment. So we need to think that possibly this candle could recover into the green, or maybe it could wick somewhere between that 20 to 25% and test the bull market support band that at least will still rhyme with previous performance. Now notice that previous year was roughly around 22%, but this is just a January that doesn't belong to post-halving year events. Indeed, this is pre-halving, but that's not the reason I'm discarding it. So far, it looks very similar, and if this was the performance we get this year, that will still make sense. By looking at the weekly chart, there is no reason for me to discard it. It is when we go into the next chart and we look at the daily time frame where I start seeing more differences. On the left hand side, we have 2024 and the current price action in January, so January 2025 at the moment, and in here you have January 2024 on the right hand side. And the thing that I'm missing at the moment is the fact that from the top on 17th of December, if we compare the two patterns, we can see that in 2024 we corrected from that top straight into a bottoming price of 38. Some people might say that there was an ABC correction just because you can do something like this, A, B, and C. In my opinion, this B is just too short to be considered a B, but you know how it is, things with trading, very subjective indeed. The second reason is because during this year, last year, we have one bearish cross on the MACD, then the fake out right here, which corresponds to this one, and then in here we have a bullish cross. At the moment, in the MACD, this year, we are about to confirm a third bearish cross. This is not confirmed. The daily can possibly, if we have an impulsive move to the upside, we could undo it, but to me it looks almost settled because of the direction and how close they are in the closing price of yesterday. In 2025, what we are doing getting is an A, B, and potentially if we bottom somewhere lower, we get a C. Let's assume it's somewhere there. Just allow me to pick any random place, and you can see that that B is quite significant. On the right hand side, now I'm gonna do a trip to 2020, 2021, and we're gonna do the same exercise to see if there is any significant similar pattern. So from the top, which in this case is in January, in this case is in December, we already say 2 weeks earlier, we come down to 30K, and then we have this dead cat bounce, which is the B, and then we bottom at 28,750. So you can see that 2020, assuming that in 2025 we get this C level of the ABC somewhere in here, we could do something very similar to 2020. But when looking at 2024, I just think that this is invalid. This was just a single move down to here, and after that there is immediately a push to the highs. It's almost like a V recovery. I struggle to think that this in here is an actual pivot, in other words. And why is that relevant? Because that drawdown of 20%, 21% that we had last year that people are expecting, I wouldn't take it from the performance of 2024 January. I will focus on what the price action did in 2020. That is myself. You're welcome to think the opposite, but if we did something like that, we can take other considerations that are very important from discarding 2024. And here is where it gets interesting. Number one, you get the A that is a higher low relative to this C. So that means that we should be on the lookout for a C somewhere in here, and not necessarily considering that much the head and shoulders. The head and shoulders at the moment is giving a pretty significant target, right? So I believe it's somewhere around 75K. So if I place this length in there and I put it right there in the neck, yes, it is giving something like 75K. But to me, if we get that ABC target like this, that C is a little bit too extended to match with the target of the head and shoulders. And if you study head and shoulders, and the theory says that yes, there can be a little bit of mismatch in the sizes of the left shoulder versus the right shoulder. So if you want, you can place this shoulder in here. That is valid according to the theory, but the theory also explains that the most asymmetrical that the left to the right shoulder are, the less reliable the target is. That 75K becomes less reliable thanks to this asymmetric nature of this pattern. And that is because the price should have stopped somewhere at 99.5, but the bulls in here managed to get it further, making the bearish narrative a little bit weaker at almost 103K, versus if we would have stopped right there at 99.5 where the left shoulder was. So this doesn't invalidate the head and shoulder pattern, neither the target, but it looks likely thanks to that. So let me remove a little bit of these lines. Remember, this is the ABC. Let's clear out the head and shoulder from there and some of the lines from before, including the target. And now let's do on both sides in 2021 and in 2025 a Fibonacci trend extension. We're gonna do it from the top of the price into the first rejection. This is the rejection that comes from the top and the initial one. And then we're gonna look into the move of AB, and we stretch it to the highest the price got there in the dead cat bounce. So doing the A to B move. We're gonna do the same this year, where we have a high of 108 and then we corrected to 91 point something, and then we hit almost 103K. And we're gonna observe the differences in here. So we get a move high in this, and in 2020 we can observe immediately that the pocket that receives the price and where we form that reversal is in between 28.5 to 31K, which coincides with the Fibonacci levels of 1 to 0.786. That is the pocket that served as a spring into the performance that was about to come in February. So if we were to do something similar to 2020 once again, that will mean that this correction, this AB, should find a C somewhere in the pocket between 89.3 to 85.6. That is the first level of support of the CPR as well. Notice that this year we were a lot more bullish. In January we were already above the second resistance and we didn't even touch the pivots. This was a virgin month, January. Whereas relative to this pattern, now flipping 2 weeks back in time, December got rejected by the first resistance, promising that we should have touched the first resistance again in January. At the moment we are failing to do that, and I'm looking at what happens in this area. I think it's pretty much guaranteed see that tonight we settle the MACD bearish cross and we start looking for somewhere in this area below the pivot to find some reaction in the price. Of course, this is just speculation. Past performance doesn't guarantee future performance, so you can put some eggs in this basket. Just make sure you don't put all of them in case the theory drops and all your eggs end up like a scrambled egg party. No one wants that. So for the rest part of the video, I'm gonna do a very quick update on the daily time frame and liquidity levels, just the due diligence. I hope it's gonna be very quick. Let me know in the comments if you appreciate as well including this part in the video. As you can see, we lost the point of control, the area of most volume traded. That means that we are on the second half, the lower one in the bearish area. We got this yellow level in here that we need to look at now. We say that was a resistance at 58. We can sustain that. The gray level of 35 remains the same, and the 30 as well. Those are slightly below the bottom of the range of the volume profile. Bottom of the range is at 89, but my band at the moment is between 87 and 82k. Just to have an idea, hitting the bottom of the range is 17%, which is way less than the past performance of drawdowns in January on years of post-halving events. If we went to the gray, we get 18%. If we go to the red, it's 23.4. Past performance has been between 31, which is 74k, and we have seen even 36, which brings us back to the scene of the crime. The scene of the crime relative to the breakout in here, which we already test on the daily time frame, but there are some people thinking that we could come there and revisit it just based on the most extreme performance on drawdowns in January of post-halving events. Important to note, once again, a reminder, ideally we want to find the support somewhere in here and use that as a spring following the theory of this ABC correction in here. That will be really great news if we wick into here and we do a daily close above 89, and from there we start recovering into February. By doing so, we are preventing to enter this area where there is very little structure. It's full of major fair value gaps. We're gonna look into that later, but large green candles do not provide enough structure. You can see it in the volume profile. There's barely volume in here, so that is a consequence of the price having passed so fast through here, and it increases significantly the chances that entering into this area becomes really slippery. So it will be really great to see that spring somewhere there without necessarily entering into the quicksand. One narrative against us is the fair value gap that lives between 77 to 81, which is a very good argument really to go lower than the targets of the ABC that we were talking about. So instead of doing this move like this and then reversing back up, that fair value gap could potentially cause this to come in there and then entering into the quicksand and going much deeper. So the way I approach this is having orders to increase my volume in the area of the first theory, but if that fails, we're gonna need to have enough cash to tolerate a deeper correction. In my opinion, there is low likelihood to get there, or we could say a lower likelihood, but never underestimate how low currently the liquidity is and the potential for a general market crash if S&P, Nasdaq continue to bleed into February, turning it into an actual market crash. There is no way that Bitcoin is gonna respect that ABC and just starts bouncing back in February by itself. It does need the support of the general markets to be behaving and not entering into black swan kind of event. Monthly still looks ugly to me. You see these 2 weeks to the upside. I really wish that January can undo that, but again, looking back in past performance of Januaries, most Januaries start like this and then recover by the end of January. So this candle doesn't tell us anything yet because we are at 9 of January, and literally from where we are, if general markets recover, this could turn into the most beautiful green candle, or it could also be the most ugliest candle if there is a general market big crash. At the moment, the big whales have bounced from around 0.5 in the ratio of deposits versus withdrawals, indicating that they are slightly increasing their deposits, not to a level to get too worried. We have had withdrawals since 25th of December up until the 7th of January. It's been mostly withdrawals, which was bullish, and now we are seeing a little bit of a trend up in here, pretty much thanks to these small inflows that you can see on the lower end of the chart. Yesterday as well, we saw some outflows, and this time it includes BlackRock. You can see the chart there. It's not doing a lot of damage, but I'm I'm hoping we are not gonna end up creating a large double top in here when it comes to the cumulative flows of ETFs on Bitcoin. Interesting to see that now there is some sort of slowdown from the long-term holders when it comes to selling, and that change started happening from the 1st of January. That is just going sideways, which could mean that some of them are selling, some of them are buying, and it's just going sideways. Up until the end of December, they were just pretty much selling and the short-term holders were buying, so there was a distribution, but in here they kind of slow down a little bit. I'll let you know if I see any intense buying from them, if we see a drop down in the price, because that could be something bullish to note. If you missed the video yesterday, I moved this line of the support of the weekly RSI of this whole bull market from 2022. I move it from being in here, touching these two levels perfect, and I did some sort of compromise to make sure that this rejection, and these three levels of support are roughly touching the line, so we can draw some conclusions later this week whether that is a rejection and we are still in a channel down, or if we recover above the yellow line, if we are gonna hit the resistance at 73 at way higher prices in the upcoming weeks or not. In the past 24 hours, there's been loads and loads of liquidations of longs across all coins, BTC as well, and actually this wasn't refreshing, but it's not any different. Indeed, you can see that there is a wall of green of people liquidated with above $1 million, including someone that got liquidated for $15 million. And now we are seeing liquidations of shorts. That is this evening with the move to 95,000. Let's see how much are the liquidations across the board. We have almost 500 millions liquidated, with 70% of them being long. That is not surprised. Let's look at the liquidity pools. Below the price, we have 91k into 89. It's pretty packed. This is the short-term liquidity, and it's definitely in this area of the 87 to 89 where we have the largest. Going up in the price, we need to move to 102.7 to start even hitting anything that is worth looking at. Longer term liquidity confirms that this area in here from 89 to 87.4 is extremely attractive, fitting at least the narrative that from the top we should do an A, B, and C. Something like this should please all the people that love Elliott waves. Let me know if I'm doing it wrong. I'm not an expert in Elliott waves. I know that there has to be some sort of proportion, so maybe a little bit deeper could be, but hopefully that's it, and we don't have to go for this packet of the CME gap, neither to the 69 that fits the narrative of a correction of 36%, similar to what we saw in 2017. Looking at the order book, we can see that the longs are stepping in at these levels. Now we are kind of matching the levels of green. We can see just one line in green, not as much as we saw in this area, but it's the start of the interest in buying somewhere in here more than selling. And it's been a long time that I don't see something close to 1 million in Delta. We got 890k in Delta. That is almost double what we were registering when the price was at 108. At that point, we say that the longs were in big risk, that this is not an area to enter a long because of the elevated risk. Now, this area is double as risky of the 108k for taking a short from here. There hasn't been any pullback to the upside to take any of this liquidation level, and I believe it's a matter of time that we see any dead cat bounce or something that takes up until the 03, 05 or golden pocket area in here, all those shorts. It's just too heavy to dump. But don't get me wrong, general markets crash. If that happened and the S&P did a correction of, big percentages, something that we could remember in the future, none of this alpha applies. So whether we have 900k in Delta and saying that the shorts are in big risk, that is relative to a normal day. If we get one of those 0.001% of the days that everything crashes like crazy, forget about all the alpha. Everybody could dump, and not just 30%, Bitcoin, it could go way beyond. Indeed, in 2021, in May, the correction was 56%, and that was not in the middle of a black swan event. That was just the typical correction of the summer after a huge rally. We are not in summer. This is not the time of the cycle to experience something like that without a black swan event or a big market crash, but do not plan things assuming that nothing will ever happen. Looking at the order book, you can see that some orders have leaped from 89. I think yesterday we were seeing them at 90. Then they became heavier but moved down to 89, and now we are seeing them at 88. So they're kind of deciding what to do with these orders where to place them. Notice that I'm using the percentiles of 98. This should look like this indeed, and you should only be able to see the almost 200 million of selling that there was at 100k, and at 110, interestingly, there is 81 million. So now relative to that, this support, you can see that it's very shallow. It will be good to compare it with the support right before shooting back up. For example, in here we have 65 million that never got hit. The price went just into 92 and then it bounced to 99. So areas with big liquidity represent demand, but not always gets fulfilled, and still price rallies. In here as well, there was demand with 50 million and price went slightly lower. They pulled that out and then we rally into 102. So now we have these levels there. The point I'm trying to make is that there is no guarantees indeed that you put your order at 88k and price will hit it and it will bounce automatically. Otherwise, everybody will be doing that successfully. Indeed, many people put these orders. Those are visible there, and you can tell that sometimes, they don't get them filled or they pull them out a few seconds before because they are trying to trick you. I also wanted to look at the sizes of the liquidation. Yesterday, people were claiming we have huge sizes of liquidation. The typical level that we have been reaching in this bull market whenever we liquidate longs is 311. I don't know what is measuring this thing, but I see consistently, with the exception of July, that we hit that 300, and the bubbles are also showing those sizes of longs being liquidated. With the exception of July, every bubble is more or less the same size. I am expecting a big liquidation of longs somewhere in here, hopefully in summer, but I have that level there as a forecast for the future. And in December 19, we got all these longs liquidated with the move from 108 into 93, and what we have done so far that people are freaking out hasn't been that much really. It's less than half what we had less than a month ago. So that is a little bit creepy as well. I suspect that if the price carries on into this area of red, right, somewhere in here, we should be seeing a spike in liquidations just because we haven't hit red in quite a while. Look at this move in here, went into 93 from 108 and it was not red. So getting into this initial red there should bring back those large liquidations, and with large liquidations typically we see some relief to the upside. That's the point I'm trying to make. For example, large liquidation upside, large liquidation upside, and it doesn't need to get to 300. Sometimes somewhere 70% of that is just enough to move back up. Also the delta, as a consequence, if we go in here, probably is going to attract a lot more shorts, getting somewhere in this vicinity, and we could catch a very decent swing high for a trade. So for that, keep an eye in the next days on my Telegram, Instagram and Twitter. I post daily updates. The links are in the description. I think this video is already too long. I'm gonna leave some for the video in the evening, which is going to go live to the CoinBureau trading channel. So make sure that you are subscribed there as well. Today is Thursday, Tuesdays as well, and Sundays I'm publishing on CoinBureau trading channel. Guys, if you want to trade with two of the top best exchanges in my opinion and have access to the best services, the longest list of altcoins that you can trade, consider using Bybit or OKX. Both of them offer huge rewards of 30,000 and 60,000 on OKX. But if you want to stay away from needing KYC, not needing to use a VPN to trade, then consider Bluffing or 2bit. Both of them are offering big deposit and bonuses, lowest fees to trade. All the links can be found in the description. I'll see you tonight in the video on CoinBureau trading. Bye bye.